Something is seriously wrong in the silver market. Look, while most people are glued to the daily price action, hypnotized by the green and red candles, they're completely missing the real story. And that story isn't unfolding on your screen, it's happening in the cold, dark vaults of the world's most important precious metals exchange. The COMEX just dropped numbers that should frankly terrify anyone holding a paper silver contract. So stop scrolling for a second, because what I'm about to show you is arguably the most critical development in the silver market this decade. We have the official numbers. The shocking delivery data shows the physical inventory hasn't just dipped. It has plummeted. A staggering portion of the total stockpile has vanished in just a matter of months. In this video, we're not just going to show you these numbers. We're going to connect the dots. We'll explain exactly what happens when the vaults are finally, officially, empty. This isn't about the daily price flip-flopping. This is a story of paper promises crashing into physical reality. For years, a delicate and many would say fraudulent game has been played. It's a game where mountains of paper contracts, derivatives, and ETFs were conjured out of thin air, all supposedly representing a claim on a single physical ounce of silver. But the one rule that could never ever be broken was that not everyone could ask for their physical metal at the same time. Today, that rule is being broken. So here's the bottom line. The COMEX is officially running out of silver that's actually available for delivery. And this isn't speculation or some conspiracy theory. This is based on their own published data. Let's get into the numbers. The total inventory of silver in COMEX-approved vaults has collapsed by roughly 31% in less than 5 months. It fell from 532 million ounces in October of 2025 down to just 366 million ounces by late February 2026. But the real story, the number that truly matters, is even worse. You see, within that total inventory, there are two different categories, eligible and registered. Think of it like a warehouse for a high-end retailer. The eligible silver is all the inventory sitting in the back room. It meets the quality standards, the right purity, the right bar size, but it's privately owned and it's not for sale. The owner hasn't signaled any intention to part with it. The registered silver, on the other hand, is the metal in the front showroom with a price tag on it. It is the only silver legally available to be delivered to someone who wants to cash in a futures contract. For years, the market has just assumed that if the showroom gets a little empty, the owner will just move more product from the back room. But what if the owner of that inventory says, nope, it's not for sale? That is precisely what we are witnessing. The registered stockpile has been decimated. It has plunged below the critical psychological line of 90 million ounces, hitting a multi-year low of just 86 million ounces as of late February. To put that in perspective, this registered inventory has collapsed by over 64% from its peak. The showroom is being emptied out, and there's no guarantee the back room will ever be opened to restock it. This isn't a leak. It's a gusher, and it's leading us to a point of no return. So where did all that silver go? It got delivered, and the rate of these deliveries is something we have never seen before. This is the single biggest signal that the silver squeeze, long predicted by market veterans, isn't some future event. It is happening right now. In January and February of 2026 alone, a jaw-dropping 74.38 million ounces of physical silver were pulled out of the COMEX vaults. Let that number sink in for a moment. In just 60 days, buyers demanded and received physical delivery of an amount equal to 86.4% of the entire registered stockpile. The so-called deliverable supply was almost wiped out in 2 months. The historical data shows that the number of contracts standing for delivery in February was 5 to 8 times the normal level. This is not business as usual. This is a bank run in slow motion. But here's where the story gets really dangerous, beyond just the technicals. This is where the true peril of the paper market is exposed. Right now, the open interest, the total number of outstanding paper contracts for silver is more than 4 times the amount of deliverable registered metal for every single ounce of silver in the showroom ready for sale. There are at least 4 different paper claims demanding it. What happens when those contract holders all decide they want the real thing instead of another paper promise? We're about to find out. The March 2026 delivery month is shaping up to be a potential breaking point. As of late February, there were over 10,500 contracts standing for delivery, representing 52.63 million ounces of silver. Those contracts are a demand note against a registered stockpile of only 86 million ounces. More than half of the entire vault could be wiped out in a single month. This extreme leverage is the dynamite at the foundation of the paper market. The deliveries are the lit fuse. And this isn't just a New York problem. The drain is global. In Shanghai, the world's other major physical trading hub, the situation is even more dire. Inventories on the Shanghai Futures Exchange have plummeted to a minuscule 10.24 million ounces. The desperation for physical metal in Asia is so extreme that buyers are willing to pay enormous premiums. The spot price for silver in Shanghai has been seen trading more than $10 higher than the price in London or New York. This isn't a small arbitrage gap. This is a massive signal of physical scarcity. That premium acts like a powerful magnet, sucking the world's limited physical supply eastward, away from the COMEX, and ensuring the vaults in New York can't be easily refilled. The world is screaming for physical silver, while the COMEX is pretending its paper promises are just as good. For decades, the silver market has been balanced on a knife's edge, but now a new unstoppable force has entered the equation, a structural supply deficit that isn't cyclical but permanent. The world has physically consumed about 820 million more ounces of silver than has been mined since just 2021. That's a shortfall of nearly an entire year's worth of global mine production. That deficit is the engine driving this crisis. Roughly 60% of all silver demand now comes from industry. This is the silver used in solar panels, electric vehicles, 5 grams networks, consumer electronics, and now an explosive new source of demand from AI data centers. And here is the crucial point. This demand is almost completely inelastic. An electric vehicle manufacturer or a solar panel producer doesn't care if silver is $30, $50, or even $100 an ounce. The amount of silver in each unit is tiny, but it's absolutely essential. There is no substitute. They will pay whatever price is necessary to secure the metal and keep their multi-billion-dollar production lines running. This silver isn't being stacked in a vault. It's being consumed, used up, and scattered, never to be easily recovered. It's a one-way street from the vault to the factory floor. Compounding this industrial drain is a monumental shift in behavior from the smartest money in the room. Institutional players, including giants like JP Morgan, are changing their strategy. For years, they were happy to play the paper game, just rolling over futures contracts. Now they are increasingly standing for delivery. They're issuing delivery certificates and taking possession of the physical bars. Why? Because they can read their own data. They see the deficit, they see the relentless industrial demand, and they are quietly moving their chips from the paper promise side of the table to the physical reality side. They are using the COMEX not as a price discovery tool, but as a physical sourcing mechanism, effectively draining the very system that underpins the paper price. This is a massive vote of no confidence in the paper market by its most powerful participants. When the creators of the game start cashing in their own chips, you know the end is near. If you're getting value from this deep dive into what's really moving the silver market, if you believe this information is critical, do me a favor and hit that like button. It tells the algorithm that more people need to see this data and understand the forces at play, and make sure you're subscribed with the notification bell on. Because this story is accelerating daily, and you won't want to miss our next update as this situation unfolds. So what happens next? What happens when the showroom is empty and the backroom door is locked? We don't have to guess. History gives us a clear blueprint for what a true physical squeeze looks like. Many of you will remember the story of the Hunt brothers in 1980. They tried to corner the silver market, and in the process they drove the price from single digits to nearly $50 an ounce. In today's inflation-adjusted dollars, that's a price of around $170. The parallels to today are striking: an extreme drawdown in deliverable inventories and a massive disconnect between paper claims and available physical metal. But there's one key difference that makes today's situation infinitely more explosive. The 1980 squeeze was driven by a few wealthy speculators. The market could and did change the rules on them to break the squeeze. But today, the squeeze is not being driven by speculators. It's being driven by a structural global industrial deficit. You cannot change the rules on physics. You can't just tell a solar panel that it no longer needs silver. This demand is real and it's irreversible. For an even more dramatic example, just look at what happened to rhodium. Like silver, rhodium is a critical industrial metal with no easy substitute. When a supply deficit developed, its price didn't just double or triple. It went parabolic, surging from around $600 an ounce to nearly $30,000 an ounce as desperate industrial users scrambled to secure the last available physical supply. This is what happens when price discovery breaks free from the paper markets and becomes dictated by raw, physical scarcity. This leads us to the ultimate fear of every paper contract holder: a delivery default. A default doesn't mean the lights go out at the COMEX and the doors are chained shut overnight. It'll be much more subtle. It will likely come in the form of a force majeure or a cash settlement. The exchange will announce that due to circumstances beyond their control, they can no longer deliver physical metal as promised. Instead, they'll close out the contracts by paying the holder the cash equivalent of the current manipulated paper price. This would be a public, undeniable admission that the paper price is a fraud. It would be the moment the world realizes that their paper silver ETF, their unallocated silver account, their futures contract is not a claim on silver. It's a claim on dollars, exposed to the very currency debasement they were trying to protect themselves from. The moment that cash settlement is announced is the moment the world splits into two separate markets: a worthless paper market and a physical market where the price is unknown but orders of magnitude higher. We're already seeing the first signs of this price reset. The market is starting to recognize how absurd the situation has become. Silver has already shocked the world in 2026, blowing past all the complacent Wall Street forecasts from 2025 that called for $42 or maybe $65 silver. It surged to over $121 an ounce in January before pulling back to a new, higher floor around $90. This is a new reality for silver. Analysts at major institutions are finally catching up. Projections from Citi now call for a $150 silver price, not as a speculative peak but as a price necessary just to begin balancing the market and curbing the massive physical deficit. Even the more conservative forecasts from J.P. Morgan, while warning of risks, are targeting an average price in the 81-85 range for the year, a level that was considered a fantasy just a year ago. So what does all this mean for you? For the average person just trying to protect their wealth in a world of financial instability, it means the fundamental reason for owning physical precious metals has never been more validated. The drain on the COMEX and Shanghai vaults is the ultimate proof. The largest, most powerful players in the world are telling you through their actions that they want out of the paper system and into the safety of hard assets. They are front-running the inevitable collapse of this paper charade. The only logical solution to a crisis in the paper market is to remove yourself from that market. Owning physical silver that you can hold in your hand is the only way to ensure you're not left holding a worthless paper promise when the music finally stops. It's the only way to be certain that you're on the right side of the great reset between paper and physical. Let's just recap the inescapable facts. 1. Registered deliverable silver on the COMEX is at a historic low. 2. In just 60 days, buyers have demanded and taken an amount equal to 86.4% of that entire registered stockpile. 3. The world is running a structural silver deficit that has consumed over 820 million more ounces than have been mined since 2021. 4. Paper claims on silver now outnumber the available physical metal by a massive ratio, creating a dangerously leveraged system. Something has to give. There are only two ways this can possibly end. Either the paper price of silver must rise and rise dramatically to a level that finally destroys demand and incentivizes new supply, or the physical delivery mechanism will break under the strain, leading to a default. There is no third option. The system simply cannot continue to bleed physical metal at this rate without a violent repricing. The choice of which side of that event you want to be on, the side holding the paper promise or the side holding the physical reality, is yours. But now you have the information to make an informed decision. This situation is evolving by the day. Subscribe to this channel and make sure you hit that notification bell so you don't miss our next critical update. And now I want to hear from you. Drop a comment below and let's have a discussion. Do you believe we are headed for an official COMEX delivery default? Or will the powers that be find a way to change the rules once again and kick the can down the road? Let me know your thoughts.